So I welcome everybody to this conference, this GAPLA conference, our first online conference. We had some talks, but this is our first online conference. And yesterday I looked up. I joined this organization in 2007, not the organization I joined actually in 2000, but the board in 2007. And in 2009, we did our first Australian conference. And we had decided at the time that we will do one conference in Australia in the Australian autumn, and we do one conference in Europe in the European autumn. And as I can see, we have managed that really every year. We have been I see this from here. I see we've been in Sydney in 2009, 2010, Melbourne 2011, Brisbane 2012, Sydney 2013, Wellington 2014, Adelaide 2015, Sydney again 2016, Melbourne 2017, Sydney 2018, and Brisbane 2019. And in a way, it's obviously sad that we were not able to have an actual physical conference this year, where we had such a, what should I say, proud history of never missing one. But we also decided in the board that it actually has some advantages too, because this will be our first conference where we really have our Australian and European colleagues being able to join in large numbers at the same time. Obviously, it wasn't easy in the past to come to Europe or to come to Australia, depending where you live. And this is actually a format which allows conferences that are targeted to both regions in one conference. And I really like that idea. So irrespective of what we will do in the future with physical conferences, I think that format most certainly we will use in a different context in the future. Now, we have a very great lineup. I will not introduce anybody because that will be Claudia's job after housekeeping. But I do welcome everybody, and I hope we have a lovely conference, socially well distanced. Yeah. So welcome to everybody.
Thank you very much, Michael. And I think we can comply with our social distance requirements. So that's good news. Just before we start with the housekeeping, just a quick side comment to Juliana. There seem to be some participants trying to sign up, but getting an error message saying this conference will start at 9 in Germany.
Right.
So perhaps if you could have a quick look at that while I deal with the housekeeping, which I must say there's not very much housekeeping given that we're all in different locations. One thing that I did want to raise with everyone is that you can only see the today's speakers on camera. So you should be able to see Chloe Burnett, Jennifer Yeo, and Angelica Yates on camera. And I will introduce each of you separately before your presentations. And also on camera, for those who don't know us, Michael Kobras, obviously our board member, and also board member Julia Werther, who is in Berlin. Michael, I should have said, is in Sydney, and so am I. All other participants can speak, so they can unmute. You can unmute yourselves, but you won't be able to turn on your video, which we have arranged so that the connection doesn't break down if there's too many videos. First topic today is taxing multinationals. Chloe Burnett will tell us about the two-pillar project of the OECD. That project is a very ambitious plan to harmonize and increase the taxation of multinationals to address some of the issues we see with businesses operating internationally and in different countries. For example, the exploitation of tax rules. Now, Chloe Burnett has got a very impressive curriculum. She studied and worked internationally in Australia, the UK, and the US. And I believe she's also spent some time in Germany working as a guest researcher at the Max Planck Institute in Munich. Now, Chloe's career in Australia includes working as a solicitor at the global firm Allens Linklaters and as the associate to the Honourable Justice Edmonds at the Federal Court of Australia. Chloe is now a barrister at 6th Floor Selborne Wentworth Chambers and was recently appointed senior counsel. Now, for our colleagues in Germany or overseas, senior counsel are barristers who have demonstrated outstanding skill as advocates and advisors in the administration of justice. So once again, congratulations, Chloe, on your appointment, and I now hand over to you.
Thanks, Claudia, and good morning to those in Germany or German-speaking countries, and good afternoon to those in Australia. I think we'd all been hoping we could meet in person in a glamorous location in Australia or Germany. And it's in tribute to that aspiration that I've put up a glamorous backdrop to my screen, which I think looks a little like what I imagine a German law school would look like. But in truth, it's actually the law school of the University of Buenos Aires, which has nothing to do with what I'm going to talk about, but it's just, that was a trip I took in the past when we were allowed to get on aeroplanes and travel internationally. And I had the photo on my desktop. So I will share my screen because I've prepared a few slides. I plan to speak for about half an hour, perhaps, on my topic. And then I very much I plan to leave some time for questions or discussion, and so I welcome any questions. You can ask me questions along the way. It might be easier to have them at the end, and also when I'm sharing my screen, it's a little harder for me to see the question interface, but I do welcome any questions along the way, but hopefully we can also have a bit of a interactive discussion towards the end of this hour. So I'm going to talk about some recent developments in the taxation of multinational companies. And I'll focus on what's coming out of the OECD. But to set the scene for that, I want to talk first about what we've seen in Australia in recent years. And perhaps we can contrast that with the benefit of the German participants with what's happening in Germany. I imagine there'll be some very similar trends, but probably some differences in the detail. Then I will open up the focus to the international developments in around also over the last few years. The OECD's first base erosion and profit shifting project, which led to a whole bunch of recommendations and requirements for OECD countries like Australia and Germany, and non-OECD countries, many countries, to implement. And there's actually been a lot of implementation of those new rules. It's seen as a bit of a success for consensus-based multilateralism. But now we have the hardest part of that project, which we call the Beps 2.0, which is about how the world shall tax the tech giants particularly, and other very successful multinationals, and how their profits are going to be shared among nations for the purposes of tax. And that's probably the hardest part of the project. And then on top of that, COVID has made the practicalities of harmonization even more difficult. So we'll talk about what's happening there. It's still alive. And I've got some recent quotes from the German finance minister, and we might pull them apart to try to predict what's actually going to happen in the next couple of years. So in Australia, many commentators question the need for Australia to adopt all of these sort of harsh high taxing measures from the OECD on the basis that Australia has actually really ramped up its taxation of multinationals in the last few years anyway, regardless of what the OECD was doing. Nonetheless, we've also implemented quite a few of the OECD recommendations, but the way that multinationals are taxed in Australia and the way that advisors have to advise multinational companies that are either inbound into Australia from abroad or Australian multinationals expanding abroad. It's all become way more complicated with so many new sets of rules and laws, which are generally added on onto the system sort of as a bolt-on rather than in a coherent way. But the developments we've had in recent years are that we rewrote our transfer pricing laws, which are about making sure that related companies transmit goods and services between them at an arm's length price, so that that's not used as a device for shifting profits into low tax countries. We rewrote these laws and made them quite sort of strong from the perspective of the revenue. They allow the Australian government to effectively recharacterise a transaction in certain circumstances, which is considered a little bit controversial globally. And there have been a couple of court cases in Australia about transfer pricing, which have had precedential effect in other countries. Transfer pricing is not often litigated around the world because it's very time consuming to litigate. It's also quite susceptible to settlement because unlike many tax issues are all or nothing, it's either taxable or it's not, whereas transfer pricing you can tend to meet in the middle, but nonetheless some cases do go to court. I was one of the barristers in the Chevron case, which was the first case around the world about the transfer pricing of related party loans, which is odd that it had not been litigated before because related party debt is the most ubiquitous way that multinationals fund their subsidiaries and themselves. And there the Australian Tax Office thought that the Chevron's Australian subsidiary paying a 10% interest rate to the parent company was profit stripping out of Australia, particularly given that that was refinancing commercial paper issued in the US at 1 to 2%, because Chevron was very high very creditworthy parent company. So Chevron lost that case. But by contrast, the Glencore transfer pricing case was about the pricing of copper concentrate, which was mined in Australia and then transferred to Glencore. Glencore is a Swiss headquartered multinational, as you know, transferred to a Swiss subsidiary of Glencore. And there was the argument the ATO made was that Australia was charging too little for the copper and not making enough profit in Australia, but Glencore won that case by proving that the terms of the copper concentrate transaction were terms that you would observe in arm's length contracts. But nonetheless, the tax office continues to be quite aggressive on transfer pricing, and there's a lot of transfer pricing sort of pre-litigation in the pipeline in Australia. And I'm also in another related party debt case coming up for hearing early next year, which is about Singtel, which is the Singaporean company which owns Optus, the second biggest telco in Australia. And it's about how they financed Optus over the years with suspected profit shifting up to Singapore. That's now a little bit uncertain because it was listed before Justice Simon Stewart, who today was appointed to the High Court of Australia. So we'll have to get a new judge for that case, but I think it will still be heard early next year. Some other sort of innovations that Australia has passed in the multinational space in recent years include the Multinational Anti-Avoidance Law, which is directed to the avoidance of a permanent establishment, which is the topic Angelica is going to talk about today. But essentially, this is about business models that particularly the tech giants were adopting. Until quite recently, if you were in Australia, and this was a common model in Europe as well, that a consumer contracting to buy, say, a Microsoft subscription or an Apple device or products of several multinationals, the consumer in Australia would actually find, if they looked at the contract, which nobody does, that they were contracting with a Singapore entity. Usually Singapore in this case. In Germany or in Europe, the consumer was often contracting with an Ireland entity. And the tax authorities thought that this was about avoiding having a taxable presence in Australia or in Germany, and there were disputes in Australia which were very similar to a number of disputes that the same multinationals had in many countries, particularly in Europe, about avoiding PE status and avoiding a presence and contracting directly with these sort of hub jurisdictions. And Australia responded to that by saying, we will penalise you if you artificially avoid setting up a subsidiary in Australia. That actually really just, the penalty is not often imposed. The result of that was these companies undid that structure and started contracting out of their Australian subsidiary anyway. We have a diverted profits tax, which is not really a separate tax. It's just part of the income tax, but that's supposed to be designed at additional means of profit stripping out of Australia or base erosion out of Australia through what the ATO regards, which is the Australian Tax Authority, regards as excessive, say, related party royalties. They didn't like, say, the Starbucks model, where the royalties, you know, the cup of coffee is worth 1 cent and the rest of the $3.99 is all royalties that go into a tax haven. That is an exaggeration, but that was the perception. So we have the diverted profits tax. Again, not much, actually, it's not really used, but it has resulted in restructures to have slightly less aggressive structures. We have anti-hybrid mismatch rules as of the last couple of years, and this was a recommendation of the OECD Beps project. I believe Germany has passed very similar rules as well. And that's directed at neutralizing the arbitrage you can get by creating cross-border structures where a single transaction is characterized in different ways in the two countries, which can lead to like a tax hole, a black hole where nothing gets taxed. Or if done poorly, it can lead to double taxation, but competent tax lawyers ensure that never happens. So we now have the anti-hybrid mismatch rules, which many tax advisors think have taken all the fun out of this area of law. And potentially they actually they're quite extensive and go quite far. And my friends who do sort of deal tax advisory say they're extremely difficult to deal with. Australia, like Germany, like many countries, has thin capitalization rules, which are aimed at stopping too much debt being pushed down into Australia and creating interest deductions, which erode the tax base. Australia strengthened its thin cap rules to make the debt equity ratio at which interest becomes deductible even lower, or that the cap was even lower. Australia does that on a balance sheet approach where you can deduct interest on all of your debt so long as it's below a ratio of 1.5 to 1 of equity to debt. Germany does it in a very different way. They use a profit and loss statement approach where any interest is deductible up to 30% of earnings before interest, taxes, depreciation and amortization. And Australia is looking at whether we might adopt a similar kind of 30% rule that Germany's had now for many years. And in fact, when I was in Munich at the Max Planck Institute, I was studying the German rules in this area because they've become a bit of a template that the world's adopting. Australia has also adopted country by country reporting, as has Germany, as have many countries. And this is about giving each tax authority visibility about how much tax is being paid to all the other tax authorities. And that was what was lacking before. And that's what led to the sort of outrage about special tax deals and special rulings when it was learnt that Luxembourg was giving multinationals these very preferential rulings. So they had large presence in Luxembourg, but hardly any taxes there. That was extremely controversial when that came out. And so this kind of reporting is designed to give those authorities that sort of visibility and basically give them a bit of a clue about what countries to steal tax revenue off, which is the theory I have, which I shall explain shortly. So what was the background for this in Australia? Look, it's a very similar background that Germany experienced and many countries experienced. The global financial crisis of the late 2000s and the resulting dip in tax revenues, corporate tax revenues for countries, also coming at a time of austerity politics, particularly in European countries, made governments quite desperate for more revenue, and also made citizens, voters, individuals, quite aggrieved that they had to suffer austerity and they had to pay their taxes, but there was this perception that the big end of town was not paying its taxes. This came through sort of sensationalized leaks of corporate tax information, and that about how little tax the successful tech giants, particularly, and other multinationals were actually paying. We had the double Irish structure that Apple was using for some time went into the press, and the Panama Papers and the Lux leaks and these sort of revelations were showing that at least some multinational companies were successfully able to pay very low effective tax rates, well below the headline corporate tax rates in the countries they were operating. And they were managing to put their valuable assets, particularly intellectual property, which is so mobile, they were able to put this into tax havens or low tax countries. And the press got onto this, and politicians got onto this and said, hey, it's not fair for mums and dads and small business and domestic companies to have to pay their full lick of tax when these giant companies aren't paying their fair share. There's endless debates about what it really means for a company to pay its fair share of tax. You know, there's economic theory that company tax is just kind of a device for convenience. We're ultimately trying to tax the shareholder on the wealth they have in the company or the income they earned that way, but it's convenient to tax the company because that's where all the money is sitting. So there's a lot of academic debate about what really the fair share is, but at the end of the day, there is a lot of political pressure to tax multinationals. It's, dare I say, quite convenient to tax multinationals. They don't vote to the same extent that individuals vote. And often they're headquartered in some country far away that we don't really care about. And so it seems to me there's been a real political desire on both sides of politics in Australia and similarly in many countries to not go easy on multinationals and to keep taxing them. And I think with COVID, particularly for those multinationals which are doing well in COVID, particularly the tech companies, the impetus to keep taxing them and potentially increase taxes on them will stay. The last dot point here, the ATO discovered the profit allocation. So what happened in Australia, and I'm sure in many countries, was that the tax authority, and it was not easy to find this out, but they eventually found out that for, say, a certain product sold by a multinational in Australia to a consumer, say that product is sold to the consumer for $1,000, the tax office discovered that maybe $100 of the $1,000 was staying in Australia as taxable profit, but maybe $500 of it was going to Bermuda and $300 to the United States, or maybe $200 of it was going to Singapore and $200 to Bermuda and $200 to the United States. This sort of breakdown that the ATO started to see, and the ATO thought, well, we want to tax some of that money that's sitting in Bermuda. Bermuda clearly hasn't earned it. And for that matter, we don't think Singapore's earned very much of it either. And we might also have a go at the US too. And so the ATO became quite aggressive in trying to increase its share of the pie. At the same time, many other countries wanted a share of the pie. Everyone was wanting that Bermuda income. And this is why it's led to these increased measures. It seems to me in Australia that most of the so-called low-hanging fruit is now gone. We have a lot of tax measures, and the ATO measures the tax gap for different types of taxpayers, the difference between what's collected in reality and what ought to be collected on their view of how the laws operate. And in fact, the tax gap for multinationals and large corporations is very low, but the political dividend from taxing them is still there. So there will still be these measures. In fact, the tax gap is much larger for small businesses and for individuals putting in dodgy work-related deductions claims, but politically that's much harder to attack. The ATO has a reputation internationally for being quite an aggressive, well-resourced and intelligent tax authority. ATO has recently recruited a lot of high-level management from the private sector, from the big four accounting firms particularly, And so they know intimately what's been going on. And then they flip to the other side to become the enforcer, the gamekeeper. And the ATO has received large tranches of funding from the Commonwealth budget to go after tax avoidance. And so I see in my job of working in tax disputes that the ATO is very well resourced to have a lot of fights about these things. This year, with the unusual circumstances we're in, there's been some administrative relaxation of some of the strict rules to account for changes in the economy and business practices due to COVID, but they're mainly just administrative gratuities. You can't rely on them in court. And the stimulus measures that the government has been giving are really directed at individuals and small business. The government is trying to make sure that the large companies that are actually doing okay are not being given a break. All right, so internationally, the OECD Beps project was the sort of multilateral response to the global financial crisis and the G20's desire to do something about it. It started in 2013 as just an initiative of the OECD member countries, which currently number 36 countries, but it expanded to include 100 other countries. So most countries of the world are now part of this project, and the other countries have equal footing with the 36 OECD countries. So it's not just a rich country project. The original Beps project produced 15 different actions of varying levels of sort of mandatoriness. But it was quite impressive that quite a few of them were mandatory and have been widely adopted. And all of the OECD works on consensus, and even the inclusive framework works on consensus. So you need to get agreement of 130 something countries. And so it is regarded as pretty impressive that they managed to do that. And now we wonder if it will happen again. Australia and Germany implemented many of the actions that came out of this. A further extension is that civil society is calling for the country by country reporting to go into the public domain so that journalists and academics and everyone can get the full detailed understanding of companies' tax positions. That's sort of inconsistent with the typical view we've taken that a company's tax return is secret and confidential. Australia already does disclose a little bit of corporate tax data, but it's a very small number of figures that gets released. In Europe, I understand there's a real push for the country by country reports, all of that data to go into the public domain. I think Germany had opposed that for quite some time, but now is a little bit more on the fence and seems to recognize that the majority of European countries want to do this. But in Australia, that's not something that's being discussed. And I think under our current slightly more conservative government, that's not going to happen. So where we're at now is that basically the hardest part of the Beps project was shelved, which was how do we tax the tech giants? That was what it was, the largest part of it, and that couldn't be achieved by consensus in the first round of the project. And the hope last year was that we would actually get a consensus position on that, but COVID's come in and made everything a bit harder. But I think something is going to happen. The reason for trying to have this project is that many countries are now trying to tax the large technology companies through what's called digital service taxes, sort of a standalone tax imposed often on a gross basis on the revenues that these companies make from customers in that country. And it's typically about things like online advertising income, which is the largest stream of income that Google and Facebook make, where the advertiser is located in one of these countries that has the tax: UK, France, Italy, Spain, Austria, Poland, India, Japan, Korea, and many other countries. That country will withhold a certain percentage of the advertising fee that the consumer pays to Google or Facebook, and will withhold that to keep as taxes, even if Google or Facebook has no presence in that country. But it's not just online advertising, it's other online services. If you have a subscription to an online service, or if you use sort of online booking or Spotify or many other online based companies are subject to these taxes. Not all of Europe has implemented such a tax. Germany hasn't, some other countries have not. Obviously Ireland hasn't because many of the companies are headquartered in Ireland for European purposes. Australia doesn't have such a rule. But these taxes are pretty hefty, and the United States, which is where the majority of these big companies, not all of them by any means, but the majority are headquartered there. The US has gone ballistic about these rules and is threatening trade sanctions on these countries, particularly France, on French cheese and wine. And it's become all rather tense. So the OECD stepped in and said, hey guys, we're going to solve this fight by creating a lovely multilateral solution that everyone can agree with, and then we'll dismantle these terrible digital service taxes. So that was the hope. When it was announced last year, it was supposed to be sort of finalized this year, which now seems laughable. The OECD is still talking about finalizing this next year. The difficulty is that to achieve this sort of consensus-based multi-country solution is extremely difficult without face-to-face diplomacy. It's, you know, on the surface, it looks like a very technical tax-focused matter, but actually it's sort of a soft law diplomacy negotiation matter. And the people that are sent by countries to the OECD to negotiate these aren't technical tax lawyers. They're more diplomats. And I'm told by Australia's representative, who has been doing this work for the last few years, that really all the major breakthroughs took place not in the formal meetings, but in the coffee break between the formal meetings, where you don't have to keep up a face and an edifice, and people can actually get through to each other and have the private conversations, which are what forge this international agreement. And I think, as all of us know, working in this sort of Zoom, Microsoft Teams, WebEx environment, it's really hard to create that sort of informality that would encourage people to come together. So I suspect that the OECD is going to have real difficulty until we can get back to face-to-face diplomacy. Interestingly, there is a United Nations competing measure, which is way more simple than the OECD over-engineered approach. And that might actually have more success than the OECD approach. So the UN has a model tax treaty for developing countries and middle-income countries. And they're sort of a competitor to the OECD. The OECD tried to steal their thunder by having the inclusive framework, but the UN now is just saying, look, countries, you can have these digital service taxes, but we're going to create a bit of a uniform model for them. This type of withholding tax on automated digital services. So I think that's really interesting, and the UN should be applauded for that. And the saying that people often talk about in this context is, you know, when we were in the space race last century, the United States was spent billions of dollars and many, many years trying to invent a pen that would write in space, whereas the Russians used a pencil. And that's sort of the analogy. Sometimes these things can be overcomplicated. Now, so speaking of overcomplicated, Pillar 1 and Pillar 2 are these ambitious models to sort of reframe how countries tax multinationals. The idea is that they would be kind of uniform rules that countries would either implement, or if they choose not to implement, they'll be quite punished by not being able to tax as much revenue, or by having their competitive advantage as a low tax jurisdiction eroded by the existence of these rules in other countries. So they're very interesting rules from sort of a game theory perspective, but they only work if they get implemented by a critical mass of countries. So they do two different things. Pillar 1 is supposed to be the way that we tax the large technology companies. And if it's implemented, it will give the so-called market country a right to tax a percentage of the profits. So not just a sort of flat fee, but a percentage of the profits from transactions between the consumer in that country and digitalize multinationals. The market country is the country where the customer is, and the customer here is like the advertiser who pays for advertising space on Google or YouTube or Facebook or the like. In some cases, it might be the consumer who uses the service or subscribes to it. It's their country that can tax regardless of whether that company has any physical presence in the country at all. And as we'll see from Angelica's rule, that really defies the traditional notion that there needs to be a permanent establishment, a PE in a country before the country can tax a company. So it actually looks more like a consumption tax than an income tax to me, but it's discussed within the framework of income taxes. It was originally about the tech companies, but the US said, no, we're not going to participate in this if it's only about the tech companies because they're mainly on our soil. We want it to include all consumer-facing companies, including, say, car companies, headquartered to a great extent in Germany. Now, car companies, they're not really technology companies, but they do benefit from intellectual property, and they do have some capacity to shift that around for tax purposes. And they also, of course, all have websites. Every business has a website now. And so it's notionally been expanded to any consumer-facing business with some degree of digitalization, which is basically everyone in this day and age. And if it's successfully implemented, it should replace these digital service taxes that are proliferating. The OECD earlier this month released its blueprint for what this should look like, but it was a bit of a disappointment because it's clear from that blueprint that there's no agreement yet on some fundamental points, whether it's going to apply just to the tech companies or to all consumer-facing businesses, what sort of percentage of profits we're looking at, and whether the rules will be voluntary or mandatory. And that last point is a pretty strong indicator that this is not a consensus position. If it has the capacity to be voluntary, then it may not go very far at all. And the US wants it to be voluntary at the moment. So I think the US might kill Pillar 1, but a lot depends on what happens, of course, next week in the US election. Pillar 2 is quite different. It's about imposing a minimum tax rate around the world for multinationals' income in each jurisdiction in which it operates. This is designed at stamping out tax havens and to some extent the sort of lower tax jurisdictions like Ireland and Singapore and Hong Kong and the like. And this is supposed to be a sort of political response to the perception that multinationals don't pay enough taxes and they can shift money around into tax havens. And the way it works is quite interesting. It's if a certain country chooses to tax that company below the minimum rate that's been imposed, whatever this rate will be, then another country can top up that tax and collect the top up themselves. And so it just reduces the incentive to shift your operations into a country which taxes below that threshold. So the rate that's sort of talked about is either 15% or something between 10 and 15%. So the tax rate in Ireland's 12.5%. Singapore and Hong Kong can be a sort of 16 to 17%. It'll probably be something around that. And it's a little bit of a free ride for the country that gets to collect the top up. It seems at the moment the rule is that the country that can collect the tax is the ultimate parent jurisdiction. But if they choose not to implement this rule, then it'll be the next country down on the structure chart and so on, down and down until you find a country that's implemented this rule. So if the US signs up to this rule, I think the US will be a major beneficiary of this rule because it's the largest headquarter jurisdiction in the world. But other headquarter jurisdictions like Germany and Japan and China will also stand to benefit. Who suffers is the tax havens very much, and so Bermuda might be completely put out of business. And the hub jurisdictions might suffer a little bit, although they're pretty entrepreneurial. I would imagine they have a strategy for this. So the blueprint there has a little bit more detail and looks a bit more promising in terms of coming to fruition than Pillar 1. So the prognosis, the spanner in the works is COVID. It's done two things which pull in opposite directions. I think it makes the desire of countries to tax multinationals, especially the tech companies, more likely because countries have massive budgetary problems now. They're looking for tax revenue wherever they can find it. And many of these tech companies are not in losses. They're making quite significant profits as everyone shifts their habits to online versions of things. But at the same time, the capacity for international consensus and cooperation is less likely because we can't get together in person, but also just, it seems we're living in a world where there's more international friction, less multilateralism, more protectionism. The US election next week might change that feeling a little bit, one can hope. Now I've got some quotes from Olaf Scholz, the German finance minister. He said that last month that the digital firms were the winners of the COVID-19 crisis. They're increasing their revenues substantially, and it is now absolutely fair to tax the digital giants. And he expressed great support for pillars 1 and 2 when the blueprints came out earlier this month, as did all the finance ministers. But I think he said in interviews that pillar 2 is looking more likely. Pillar 1 may end up just being these unilateral digital services taxes that we've seen. He and the French finance minister have indicated that the European digital taxes might be used for a common fund, for a European reconstruction fund for post-COVID. In Australia, we're not yet talking about digital service taxes, but that might come on the table once the government starts working out how we're going to pay for our budget deficit. And my guess is that digital service taxes are here to stay. We might get pillar 2 on minimum tax rates. It might not do that much at the end of the day, but it'll look like we've done something. I think we won't get pillar 1. Countries will just impose digital service taxes. The OECD will have to try to step in to harmonise them somewhat so we don't result in double taxation or too much disorganisation. I think multinationals will remain a tax target for some time to come. So that's what I have to say. And yes, I welcome any questions from those listening.
Thank you very much, Chloe, for that really interesting presentation on what is a very difficult topic. And as you said, it doesn't seem to get easier in the current environment.
Well, it's very difficult for advisors. You know, we have so many rules and they're so technical and they interact with each other in odd ways. So that's certainly difficult, but the upside, I guess, is we'll never be out of work.
That is right. Now, just for everybody attending, Chloe is happy to take questions now. So you feel free to just, Juliana, unmute yourself or raise your hands. What's easier?
Well, if you would like to speak, please raise your hand, and then the ones who are not yet allowed to talk will be allowed to talk. And if you'd rather like to drop a question by writing, then please use the Q&A function.
Okay, great.
One of the panelists has a question. Angelica, I think I don't have to unmute you.
Okay, yeah, I have a question. That was very interesting, and I have a question on the digital services tax. It was on your slide, but you didn't mention it. Actually, Australia has done something very interesting. They have imposed now GST on digital services that are imported into Australia by multinationals. It's called the Netflix tax.
Yeah.
The Netflix tax, which actually gives Australia 10% of the revenue, right? It's a GST is at a rate of 10%. Now these goods and services have to be sold at whatever price, and then there's a 10% GST component, which is already in force, right? That's already happening.
Yes. No, that's true. So we are collecting more through our GST. And in many other countries, that's also the case. The idea is that the digital service tax is on top of whatever VAT is already collected. Okay. And I think in Australia, there is a trend to include more and more imports in our in our GST, not just digital imports, but, you know, online shopping imports or low value goods. The threshold was reduced substantially. And so imports of digital services is quite consistent with that. But it's true, Australia should be recognized that it has started taxing these items.
Yes, yeah. And maybe just a second question on the enforcement side of things. So if that multinational tax would be imposed in some form or shape, and actually under the tax rules, a multinational company with a seat in Ireland all of a sudden has to pay taxes in Australia, how does the ATO enforce that?
Yeah, it's a great question. So there's already a multilateral treaty, not the recent one, but one from about 8 years ago. I think Australia joined it, where Australia has promised to collect the taxes owed to other countries and remit them to the other country, and other countries have made the same promise to Australia. So that's an agreement at the treaty level. Many countries have not yet implemented this in their domestic tax system to allow that, but Australia has. So, you know, for example, if you're a German in Australia and the German government writes to the ATO saying, here's a piece of paper showing this person has a tax debt to Germany, the ATO can collect that from you as if it were an Australian tax debt. So they have all of the hard line of the law behind them. They go straight to court and get summary judgment. And then the tax office collects the money and has to send it to Germany. So we already have the infrastructure for that. And we're trying to get other countries to do the same. But my experience is that large multinationals generally won't avoid the law. Maybe some companies will, but the ones that have some consumer-facing reputational sensitivity won't try to hide from their tax debts if they'd rather just argue that legally they don't have any.
Okay.